Once upon a time, in the seemingly untouchable fortress of global finance, a storm began to brew in the year 2008. The financial crisis, an economic tempest of epic proportions, emerged from a perfect storm of risky financial practices, exuberant speculation, and poor regulatory oversight. Allow me to paint the tale. In the heart of Wall Street, where fortunes were made with the click of a mouse and optimism flowed as freely as the coffee, banks and financial institutions had embarked on a dance with disaster. They had grown enamored with a set of complex financial instruments known as mortgage-backed securities and collateralized debt obligations. These instruments were like pies, made of many slices of mortgages bundled together and sold to investors around the world. The catch? The quality of these slices varied widely, and many of them were filled with subprime mortgages, loans given to borrowers with credit ratings that were perhaps as dubious as a cat promising to guard a goldfish bowl. The market was fueled by a belief that housing prices would perpetually rise, making these questionable mortgages safer on paper than they really were. But then reality hit. Housing prices began to fall and the underlying mortgages started defaulting. Think of it like a game of musical chairs where the music suddenly stopped and everyone realized there weren't enough chairs to go around. Interestingly, the phrase "borrowing from Peter to pay Paul" never seemed more apartment. Except in this story, Peter's loans were mysteriously backed by a house of cards. And Paul, in some cases, well, Paul didn't even know Peter. The first major sign of trouble appeared when Stearns, a prestigious investment bank, faced a liquidity crisis in March 2008. Despite efforts to stabilize, it was soon acquired by JP Chase for a fraction of its former worth, under prodding by the Federal Reserve. It was akin to watching a large ocean liner being tugged to shore by a single rowboat, a sign that perhaps something was amiss in the financial seas. Humorously, rumors circulated that a banker's idea of risk management was putting their hands over their eyes and clicking their heels together, hoping everything would be fine when they opened them. Spoiler, it wasn't. Then came September 2008, a month still etched in memory. Lehman Brothers, another titan of finance, crumbled like a sugar cube in hot tea, filing for bankruptcy with debts that made national debts look modest. Its fall sent shockwaves through global markets, analogous to throwing a boulder into a calm pond. As financial markets nosedived, global credit froze. Banks were wary of lending to each other, unsure of who might collapse next. Suddenly, the financial system's intricate web, once considered infallible, seemed as sturdy as wet tissue paper. The United States government, realizing the gravity of the crisis, leapt into action. The Troubled Asset Relief Program, or TARP, was introduced, a $700 billion lifeline intended to stabilize the financial sector by purchasing distressed assets. It was a bold move, like a lifeguard diving into choppy seas to rescue bankers clinging desperately to their balance sheets. A joke threaded through trading floors. Why did the banker go to therapy? To finally learn how to deal with unsecured feelings. Meanwhile, major economies entered recession, leading to widespread job losses, plummeting stock markets, and a general malaise that overshadowed the new millennium's early dreams of prosperity. Stimulus measures were rolled out globally, efforts that slowly but surely laid the groundwork for recovery. In the years that followed, there were significant changes. Regulatory reforms, epitomized by the Dodd-Frank Act in the United States, aimed to ensure that such a debacle would not happen again. The act sought to improve transparency and risk management, focusing on protecting consumers and preventing the too-big-to-fail phenomenon from reappearing. The 2008 financial crisis taught the world numerous lessons in economics and financial prudence, including the perils of unchecked optimism and supervision. Yet, as the dust settled, markets gradually recovered, bolstered by innovation and the indomitable human spirit driving economies forward. And so, the tale of the 2008 financial crisis slipped into history, serving as both a cautionary tale and a testament to resilience. As the gears of the global economy turned anew, they did so with a clearer understanding of the reverent balance between risk and security, one that had been forgotten, if only for a moment, in the fervor of blind ambition.